Leave the UK and HMRC can still have a claim on your entire estate for up to 10 years after you have gone. Most people who move abroad to cut their tax bill find this out the hard way, usually after they have already sold the business, invested abroad, and told everyone that they are non-resident now. This is the rule that actually decides whether leaving works out or not. And if you have watched my other videos on foreign income, this is the piece that completes the entire picture. So stay with me. Domicile is gone. For decades, UK inheritance tax turned on domicile, where you considered your real home to be subjective, arguable, frankly plannable if you paid a barrister enough fee. That is gone. From 6th April 2025, domicile no longer decides your inheritance tax position. What replaces it is brutally simple residence test. Specifically, how many years you have actually lived here. The long-term resident rule. Here is the test. Be a UK tax resident for 10 years out of the last 20 tax years and you become a long-term resident. Once that happens, your entire worldwide estate, UK property, foreign property, offshore accounts, and overseas business sits inside UK inheritance tax at 40%, not just what is in UK, everything, everywhere. The 10-year tail. So the obvious move is leave and it stops. It doesn't, not immediately. Once you are a long-term resident, there is a tail period that keeps your worldwide estate inside UK inheritance tax even after you have immigrated. The longer you are resident, the longer that tail runs, up to a maximum of 10 years after you leave. Move abroad, build a whole new life there, and if you passed away inside that window, HMRC can still tax your worldwide estate at 40% as if you never left. The capital gains clash. It gets more complicated if you're also selling a business or investment as part of leaving. Capital gains tax runs on a separate clock, the temporary non-residence rule. To keep that gain outside UK tax, you generally need to be non-resident when the sale completes and stay non-resident for more than 5 years. Come back inside that window and the gain gets taxed in the year you return, where the rules collide. So you can be running two clocks that don't line up. 5 years to protect a capital gain, up to 10 years to fully clear the inheritance tax tail. Time your return around the shorter clock and you can still walk straight into inheritance tax exposure. Just leave is not a plan. It is a starting point that needs proper sequencing. The FIG regime. No, the reforms were not all restrictive. If you are moving into the UK, the new FIG regime gives new UK residents a 4-year window to bring foreign income and gains into the UK completely tax-free, replacing the old remittance basis. If that is your situation, rather than leaving, I have got a full breakdown in the video linked over here. What to do before you leave, the real lesson. If you are genuinely considering leaving the UK, sequence matters more than the decision. Know 3 things before you move anywhere. Number 1, how many of the last 20 years you have actually been UK resident, because that sets your tail length. Number 2, whether you are planning any disposals, because that is a separate 5-year clock. Number 3, your day count and ties under the statutory residence test, because you don't get to just declare yourself gone. This is exactly what I walk through with clients, mapping the residence test and the FIG regime window. There is another video on the FIG regime over here, and tell me yes or no, would you leave the UK for good to cut your tax bill? Comments below, I will read every reply. Subscribe for real tax tips every week. Thanks for watching this video.